If you are planning to buy a home, you need to start working on your credit today. Buying a home is probably one of the biggest purchases that many of us would have to face. Your credit score can cost you thousands, if not hundreds of thousands of dollars. What's up, winners? My name is Naam. If you're new here, welcome. Here we talk all things personal finance and credit. Start out by subscribing so you don't miss out on any future videos. This video is something that I wanted to do for quite some time now due to the fact that I am looking to purchase a house within the next year. So not only am I making this video for you guys, I'm also making it for myself. So before we dig into the actual process, let's go over why your credit score is one of the key aspects of your mortgage. Essentially, a credit score is just an adult report card that shows how trustworthy you are with your finances. So let me pop this chart on the screen so you guys can have an idea of how much you can be paying in interest over the course of your mortgage depending on your credit score. So at the making of this video, which is December 8th, if I wanted a 30-year fixed loan in the state of California and I wanted to borrow $500,000 with a credit score of 760 and above, I'll be paying roughly around $206,000 in interest. This does seem quite a bit, but given the fact that the APR is roughly around 2.4%, which is ridiculously low, and the fact that every single year inflation happens and the value of the dollar becomes less, you're really not paying that much for interest. Now, let's just say that you have a credit score of 620. If this was the case, the total interest that you would be paying on the same house would roughly cost you around $367,000. This is roughly $160,000 more. In this example here, this more pertains to individuals who are looking to get a conventional loan. If you wanted to get an FHA loan, the minimum credit score is 580. But either way, a few points here and there can make a big difference in the amount of interest that you would be paying on the lifetime of your loan. But what if I have bad credit now? Can I just refinance the loan later when I build a better credit score? In this situation, you're absolutely right. It is possible to fix your credit and refinance for a better rate. But the only time that this would work is if the refinance is actually worth it. If you could work on your credit, improve your score, and you could find a loan to offer a reduction anywhere between 1 to 2% in interest than the rate that you're currently paying, then it probably is worth it and you would save more money in the long term. But this would only work if you're planning to stay in your home for a long time. So this gives you enough time to make up the closing costs. Now let's get right into the nitty-gritty of how to prepare your credit score to buy a home. The first thing that I have to mention is to plan anywhere between 6 to 12 months prior to buying a home. Now this may seem like a long time for some, but to get your credit where you want it to, it does take some time. Yes, it is possible to boost your credit score much faster than this, but the majority of the time to get your credit score to where you need it, it will take this long. There are no shortcuts to this. By planning way ahead, this gives you enough of a buffer in case of things takes much longer than expected and to get your finances in order. So you're better prepared to buy a home. The second thing that you must know prior to purchasing a home is to know where you currently stand with your credit score. I'm not saying what your Credit Karma says or what it says on your bank's app. I'm talking about your FICO 2, 4, and 5. The reason why there are so many numbers is that each credit bureau has its own label. For instance, Experian is FICO 2, TransUnion is FICO 4, and Equifax is FICO 5. These will be the exact scores that mortgage lenders will look at. It is possible that mortgage lenders may take a look at different scoring models, but roughly around 90% of all lenders and credit institutions, they use the FICO score. Probably the best place to get your mortgage FICO scores is from myfico.com. This is the same company that developed the FICO scoring model. But it will cost you because it costs us roughly around $30 to $40 a month, but I really don't see it necessary to monitor your score the whole time. Once you get an understanding of what your mortgage FICO score is, now it's time to actually work on it. If you have a FICO score of 760 and above, then there's really nothing else to worry about aside from other parts of the underwriting process. But if your credit score is anything below this number, then it's time to figure out ways to bring up your score. The next step that you want to move forward to is to get access to your credit report. If you do decide to get credit monitoring with MyFICO, you should be able to get access to your credit report from there. If you decide not to, which is perfectly fine, you can get a free credit report from each one of the credit bureaus once a year if you decide to request it. Once you get access to your credit report, it is time to thoroughly inspect every item line by line. Is there any incorrect information on there that needs to be corrected? If there is, then it is time to dispute it. Credit repair can definitely be done on your own if you want to, but if you don't have the time, I do have a credit repair company. The contact information is in the description. But either way, the journey could take anywhere between 2 to 10 months to dispute the items off your credit report. Of course, this is not 100% guarantee. In my experience working with clients, this is generally where I see the most results. This is another reason on why you should plan way ahead before purchasing a home. Once you start fixing items on your credit report, if there is any, the next step is not to do any harm to your credit. Which brings me to my next point, which is avoiding debt. One of the major components of a mortgage during the underwriting process is your debt to income ratio. So in a nutshell, your debt to income ratio is just a percentage to tell lenders how much money you spend versus how much money you actually have coming in. To calculate this number, all you have to do is add up all your minimum debts, then divide by your monthly gross income. Your gross income is the amount of money that you make before taxes. So let me give you an example. Let's just say that your monthly expenses is $2,000 and your gross pay per month is $6,000. In this situation, your debt to income ratio is roughly around 33%. Ideally, you want your debt to income ratio 36% or lower, but depending on the mortgage that you want to get, they may allow you to have a debt to income ratio up to 60%. Lenders would like to see you have a lower debt to income ratio because this will show that you have less financial stress and you're less likely to default on your loan. So what is categorized as debt in this calculation? This can include insurance premiums, auto loan payments, student loan payments, transportation costs, and also 401k contributions. There are other ones as well, but these are some of the most general categories. So whenever you are planning to buy your home in the near future, try avoid adding more debt to this calculation. Avoid getting that new car, pulling out more personal loans, or having higher balances on your credit report when it comes closer to buying your home. Now, this brings me to my next point, which is avoid opening new credit lines. A general rule of thumb, if you're 6 months away from applying for a mortgage, you should stop trying to apply for new credit lines. Due to the fact that these hard inquiries may temporarily lower your credit score up to the point when you're trying to get your credit ran. For each hard inquiry, this can cost you anywhere between 3 to 7 points. If you can wait almost a year, this will be ideal, but 6 months is worth it as well. So since we are talking about hard inquiries and adding new credit lines, the next thing that I wanted to talk about is trade lines. Trade lines can also be known as authorized users or piggybacking. This is where you essentially get added onto another person's account and you adopt their account's information. Depending on a certain type of trade line, you can actually land in a whole lot of trouble. The traditional route is getting added on as an authorized user, usually on a family member's credit card. Usually this individual has a great credit score and the credit line is pretty seasoned without any derogatory marks. The second type of trade line is to pay a third party that will allow you to get added on to another person's credit card account. This way of getting a trade line can get you in trouble and possibly jail time. I am pretty sure that there are people out there and people in the comments saying that they bought trade lines and there are no consequences, but buying trade lines and applying for mortgages, you can actually get in trouble with fraud. Lenders can count this as mortgage fraud since these trade lines that are on your credit report do not belong to you. So if you're thinking about getting added on as an authorized user, I would recommend doing it about 60 days out before applying for your loan. Just due to the fact that trade lines will have the most impact once it hits your credit report. As time goes by, they will have less of an effect. Even then, some mortgage companies, banks, and lenders, they may just remove all of your authorized user accounts and may not even factor them in during your application. So if you decide to buy trade lines, please do it at your own discretion. I would highly recommend trying to get added on to another family members if possible. When it's all said and done, just make sure that you give yourself enough time so you can work on your credit if it's not where you want it to be. If you don't know where to start, then it's best to reach out to a mortgage broker so they can walk through the whole process of where you need to be so you can qualify for the best rate. If you guys haven't already, make sure you give this video a like. I'll see you guys in my next videos.